The rally pretty widespread, but the best sectors are those that benefit the most from that drop in interest rates: real estate, utilities, and consumer discretionary. The real estate sector up 5% today. And as mentioned, Home Depot adding more than 100 points to the Dow on its own after results. There's the stock move. The latest is up 6.3%, almost helping it turn positive year to date. We'll have more on that in a moment.
All right. So is this morning's CPI report and all clear for the markets? Let's bring in Greg Branch, managing partner at Veritas Financial Group, and a CNBC contributor, and our own Steve Liesman also joins us. Greg, welcome, and Steve, you as well. Let me begin with you, Greg. Is the market getting a little too giddy here over just one inflation report, or what?
I think so. I think so. And let me start by saying that there are positives in this report. The housing component coming in softer than we've expected, and we've seen that's good. That's unique. But by and large, this is not a unique CPI report. Yes, it is below consensus. Yes, it's only 20 basis points of core growth month over month. And I think we need to focus on the month over month to exclude the base effect. But it's not unique. We have seen 20 basis points before. I had those arguments all summer that we're on a new trend to around the 2% inflation level, and it just didn't turn out to be that. And so either we needed something unique to justify this market reaction, like 10 basis points or 15 basis points, that would have been unique, or we needed to see that this is the new trend. And we can say neither of those based on what we've received, because we've seen it before. And the trend is 30 to 40 basis points. Of the last 12 reports, it has been 20 basis points 3 times, and the other 9 times been in that 30 to 40 range. And so I'm not sure how we're spiking the ball here. And more importantly than what I think you're going to see the Fed come out, as they have for the last 2 weeks, and said, you guys are not saying what we're saying. What we're saying is we don't think that we've done enough to be finished. And I'll quote Kashkari, Bostic, Powell. They all said the same thing, which is any near-term expectation for rate cuts is not grounded in reality.
There may be, Steve, an argument that many make that we're going to stay higher for longer, and there's nothing really here that says we won't. In other words, today's inflation report may suggest that the Fed may not increase rates from here, but that doesn't mean necessarily that rates are going to come down or that the Fed is going to lever them lower.
Well, there's a whole series of calculations running from this report, and I agree with Greg. The market is asking the data to be more consistent than it actually can be, and believe that the Fed takes a consistent message from this. I don't think it does, and I wouldn't be surprised if a string of coming reports that we don't end up having one that goes the other way on us and causes the market to go price in new risk on this, especially the way the market is priced right now. It's just not the way the data work. That's really the problem. But on this issue, the Fed, if the trend does continue and the extrapolation that's coming from this number does come to pass, the Fed is going to have to cut rates. And that's because obviously the nominal rate is one thing, but the Fed is ultimately aiming for some form of a real rate here. That's the way the calculations work. And today, effectively, the Fed got more tight because it didn't change the nominal rate and the inflation rate came down. So the real rate went up today. And over time, the way the market is priced right now, I don't know what the right number is, but it has 100 basis points of cuts built in for next year. The Fed has something like 28 built in. But again, that was the September forecast. We'll see again. It does point to the importance of the December forecast that's coming up. There are the probabilities you can see there for rate cut probabilities coming up. But I'm more interested in the total. The next one, guys, if you have it there, which is the cuts that are built in for next year, 100 for the market and 28 for the Fed. I suspect the Fed's number will go up, but there's one more inflation report from here, and we'll see if that trend or the extrapolation the market is getting from this number turns out to be true, Tyler.